All right, David, let me just make sure that this is alive. I got the notification that we're good to go. Let's make sure here. Great. We are live. Ladies and gentlemen, thank you for bearing with us. To all of the people who have been sitting and waiting for our show to go live, here we are. We made it. It is Thursday, March 20th. We've got a great show for you today because a ton of action, volatility, and just general, just can't miss movements in the markets have happened over the last month since our last show. Before I dive into it and hand the mic off to David Russell, let me remind you that today's wonderful show is sponsored by TradeStation. TradeStation pursues a singular vision to offer the ultimate online trading platform and services for self-directed traders and investors across the equities, equity index options, futures, and futures options markets. Equities, equity options, and commodity futures products and services are offered by TradeStation Securities, Inc., a member of NYSE, FINRA, CME, and SIPC. So here I am live with David Russell, Global Head of Market Strategy at TradeStation. You're not going to want to miss the show. There's a lot of action going on. David, take it away and make sure you give us your disclosure as well before we get started.
Great. Can people see my screen? Here we go. I just want to just show a few disclosures. I'm going to show the standardized returns of some ETFs as well that we might be looking at, that we do plan to be looking at. So overall, I think right now we have a situation where the market has pulled back pretty sharply relative to where it's been for the last year and a half. In my view, in many ways, the move that we were in until recently started in late 2023, when we had a sense that the Fed was getting ready to be dovish, and that all played out. And now we're in an environment where the market is in many ways, the valuations are high and everything was expecting a kind of perfect environment, and that makes us more vulnerable to weakness. And I think that's really the main story that's been happening. There have been some other interesting sort of things that have happened with rotation away from the dollar. We did a TradingView idea on that recently. But I think the big thing overall right now, by the way, these are standardized returns of some of the ETFs we're going to talk about if you want to take a look at that. There's a TradeStation platform. I just used it for this. But right now we're in a spot where the market's been running for a long time, and we needed to have basically an A or an A minus on the situation in terms of policy, in terms of economics, but especially the policy front. We needed to have an A or an A minus to keep the market going, and instead we got maybe a B minus or maybe something worse, whatever you think politically. The thing is that this is not an environment where things are like as perfect as they people expected them to be, and that means that high multiples are more difficult. The other thing is we're in a spot where the economic data has been weakening, and I think it's important to realize that in many ways there were signs of the economy being not enormously strong before the election. We saw things like manufacturing reports not super strong before the election, and everyone seemed to be holding out, hoping for a bunch of stimulus and positive sort of events after the election, and instead we have gotten maybe not that or something that is less positive. So as a result, I think that also kind of adds to this. So now we're in a spot where if you look at the Fed yesterday, they cut their economic growth forecast. Things like the Atlanta Fed GDP now are showing sharp weakening in the economy. So you put those, well, I don't want to say weakening, but overall sharp weakening in the data at least. You put those things together, we've had some bad earnings, pre-announcements from the airlines, which are economically sensitive. In fact, we've seen a lot of weakness in the transportation stocks. You have Dow theory kind of showing us some of that. We've seen tremendous outperformance in consumer staples, which is almost always the thing that you see before a bull market ends. You almost always see consumer staples outperforming for a period of 1 to 2 months before the market actually ends a longer lasting run. So we had a lot of things in place that kind of showed that. And now, so I think I want to kind of point out, first of all, what's interesting to me here, and I don't have it on this chart, but the pullback we had through earlier this month was basically the lowest in half a year. If you look at other pullbacks, like the pullback we had back here in August, that was like, it was a much shorter, the amount of time that was tested back, I don't have it on this chart, but one of them was like 26, this was basically 26 weeks. I think this was something like 14 weeks, and this pullback was about 8 weeks in terms of it pulled back to the low from 8 weeks prior. So now we pull back to a low from 6 months prior. That shows is a much more significant loss of momentum than we had on these other pullbacks. I also don't have it on this chart, but if you want to dig into it, you can see that MACD was rising, RSI was rising on these pullbacks before the pullbacks, it was screaming higher. You had very tight uptrends. They stalled, they crashed, and they continued. This was very different. We go up and we kind of stall. Instead of stalling in a period of 1 to 2 weeks, we stall in the period of 2 to 3 months, a big rolling top with just slightly higher highs. This is a sign of exhaustion. If you also were to look at, for example, at MACD or RSI, which I'm not going to do right now, but you would see that they were making lower highs. So that's bearish divergence we saw on this top. So I want to point out something else, which I think is actually important, because I think it actually tells a story about the sort of, policy backdrop that is behind this. This is basically the Monday, Tuesday of election day, the Monday of election week and the Tuesday of elections. And basically you can see that it's this range on the chart. Now, what's interesting is, we rallied the day after the election. We came down in mid-January. We tested election day close and we bounced really sharply. Then we came down, and what's happening now is we've gone under, and now we've come up, and now we're potentially hitting resistance at the Monday of election week. So you could almost say that the political narrative went from being a positive support to a bearish resistance, if you want to think about it, the expectations of what we're going to be getting from the White House. So I wanted to point that out. So I'm planning to maybe do this as a trading idea view for tomorrow. So that's the reason why I have this up on this chart.
I have to say that is a great insight right there, that we've actually retraced that not only the entire move, but gone below it, because there was so much optimism involved. And I feel like that's actually a good tip before we dive into some of your recent charts, especially in energy, that you're writing and creating from the TradeStation account on TradingView is, would you say that sometimes, like, whenever that level of optimism is out there, like maybe just like a wise trader might sort of take a step back and just remember that, like, if things get too bullish and too euphoric, then the scales can just tilt the other way kind of quickly. People aren't positioned really well enough. And I feel like, watching you show us that chart that we're back below those election levels really had me thinking that there was almost too much excitement, and then it just tilted and reversed quickly.
I think that's partially true, and I think also we have to realize is that this was a long time. I mean, November through the end of February, that was almost 3 months. So we had a long time for these things to happen, and so I think for me, we did have some pretty clear technical things that were showing us trouble. And the thing to me that really got me concerned was when we went up and hit this high on the 19th of February, and I had been looking at this tight range along here right around 6,000. And when we closed under it, to me, that was a very problematic sign. I had the sense that we basically had a false breakout at that time, and that's when things got very different for me. But I think the other signal that is most meaningful here is the RSI. If we look at RSI here, we can see that it basically had made, a lower high, and this is textbook bearish divergence, what we see here. So this is basically, I think, when we see the combination of this and then the foothill breakout, this to me is just a classic sort of topping and exhaustion sort of move.
And also, so based on this chart, once again, before we get to your energy ideas, I really like how you've drawn that level there. And the way to think about that, if I'm correct, is essentially that level, that significant level, which was sort of the start of the run, then held up. It's sort of the age-old support turning into resistance. Is that sort of now what we're seeing?
Exactly, and I would say in some cases it's especially potentially negative because we basically went, we didn't even reach that low of January, and so I think it just kind of says a lot that there was a lot of optimism, and then it reasserted itself here, and then it turned from optimism to pessimism here, like in the last couple of days. So to me, this chart tells you quite a lot, and I would also just say the fact is, look at how feeble these highs were. The high in mid-December was 60.93, and then the other high was like 61.50-ish. So we basically went up less than 1% from the high in December to the high essentially more than 2 months later. Less than 1%. If you look back at these moments here, we were making new highs of 1% like every couple of weeks. So it really shows, you can look at it from different ways. You can look at it simply based on, for example, the performance. And I think it's important to realize that these were consecutively strong highs, higher lows the whole way up. This didn't give us any of that. So there's a lot of different things here that were kind of emerging on the chart. And in my view, this could have been something that turned into a sideways period of consolidation for a prolonged time. And what my expectation was that we were going to basically have a prolonged period of holding around 6,000. And then we were going to potentially get confirmation that inflation was going to go away or getting better. And then when we had a sense of that, it would set us up for potentially continuation. But instead of getting a positive inflation sort of catalyst, we got kind of a negative geopolitical or policy catalyst, or multiple policy catalysts. And I think that's really what happened.
And I just want to say for all the viewers out there, this is a really nice tutorial for these moments as well. The key levels you can draw on your chart, the indicators you can watch for, and then of course, just from like a risk management perspective, like having a sense of, okay, this is where the resistance is. Here's where the support, if there's any, in this sort of recent reversal and little increase in volatility here. And one more very critical tip that we're going to get into now. David and I were just talking about this. Yes, there's been a downturn. Yes, we just got a 10% correction in many different large asset classes. But did you know there are still some interesting moves happening out there? And David's actually been publishing some from the TradingView account on TradeStation. And there's one sector that's the best sector in the market. It's been ages since we've seen this. David, take it away on this sort of insight here that, not everything is just like down, essentially.
Yeah. Well, before I even get to energy, let me just mention that for me, I was expecting the S&P to push significantly above 6,000 this year based on the things I had said of inflation getting better and of double-digit earnings growth. But, you can have a belief, and that's well and good. But when the market tells you your belief is not correct, then you have to be willing to basically go from believing it to not believing it, or even believing the opposite. And I think that's what in many ways we saw play out here. It played out with the S&P, but it also has played out with energy. And to me, for a long time, I have been pretty negative on energy. I have been talking about the weakness in China, in the Chinese economy. I've talked about the growing supply from OPEC, and all those things have been true. But the fact is, this is a weekly chart of the XLE. So this is go all the way back to 2014. And I was looking at the fact that it had made a lower high and it was moving sideways. But on the weekly chart here, I'd been looking for movements down toward 80. And basically, we kind of were moving our way down, but we didn't even get under 83. And we reversed. And this is basically the exact opposite of the S&P. In this case, instead of moving higher, instead of reversing to the downside when I expected upside, it's reversing to the upside when I was more thinking in terms of downside. So I think it's really interesting to take a look at energy here, is that basically when you look at energy, the most important thing I think to realize is that energy is what you'd call a value sector. We basically have been seeing in the market, there's this sort of negativity towards stocks that trade at high multiples. Well, energy stocks trade at the lowest multiples in the entire S&P 500. The average for the XLE members, the average earnings multiple is about 9 times earnings. And technology is like well above 20. So you have an environment here where people who don't want to be paying high multiples, they can look to something like energy. Another thing that's been happening in energy is that basically you have, well, on one hand, you have the obvious geopolitical thing that keeps kind of coming with it. But the thing is that we don't have an economy that's that bad. Jobless claims haven't gone down that much. It's not tremendously great, but it also is not terrible. And we're not seeing mass layoffs. We're not seeing like mass contraction in the economy. And that actually means that you can continue to have demand for energy. China's economy is limping, but it's not totally broken. So we're in a spot here where in many ways the demand for energy remains intact. There are geopolitical catalysts. There are also valuation arguments. And I'm looking at a series of charts that we looked at recently, like Hess, for example, that have long-term basing patterns that they've been breaking out of. And we did a TradingView idea on this one a couple of days ago, as it literally pushed up to this level around 150-ish, which was a level going back to basically right here in January. But if you look in some ways, you can see that this stock, really had been trapped under this level since last summer. It gapped down. I'm not sure that was probably an earnings report or something, but it was bearish gap from back here that it could not get back above. And here it is breaking out. So the thing that's interesting about these is that they've gone nowhere now for like 2 to 3 years. And I think that's just, it kind of gives us a sense here that if they were going to crater, they probably would have already happened. And now we're in a spot where people have not been really bullish on them, which means there's not a lot of trapped longs. And wait, let me do it the other way. Sorry, do it like this. And I think it's also important to realize that. Oops, let me get my curve on here. We do have on this one and on Chevron, we do have like a kind of basing pattern. So I want to kind of point those things out that to me are kind of telling us that this tried to break to the downside, it wasn't able, and now the environment is changing. So to me, it's interesting because I have been really kind of worried about downside in energy for a long time, and it's just not happening. The other thing is happening, and when reality changes, you got to change your opinion.
I have to say, on that note, there's two things I'd like to highlight, which is one, your commentary now. I think you've mentioned these sort of insights twice about when the reality changes, you got to change your opinion. There's that age-old quote, I think from John Keynes, which is, when the facts change, I change my mind. And there's just an element of, when these things change, you don't really want to sort of fight that change because there are just millions of people on the planet, lots of money that can also shift quickly. And sometimes if you're sort of not, if you're fighting that, it's, you're going against a tsunami of sorts. So I do love that insight. And it's really hard though to latch on to that. And I feel like sometimes that's the difference between a new trader and a great trader. And actually an insight I heard the other day was something along the lines of someone said like good traders cut positions, great traders reverse the position. And I was sort of like, wow, that is something else. Like they oh, trends change, everyone's moving, they reverse it entirely. So this chart, by the way, is really interesting with energy because something I have to say is I have forgotten about energy because I think you said it earlier. Would you say they were one of the lowest weighted sectors, or is there commentary about their valuation that really stands out? It's just sort of been forgotten about for so long.
Well, it's true. And the thing is that valuation has been a dirty word recently. High multiples have been something people don't want. And there's a lot of reasons why. And I do think we're in a spot here where on one hand, we did a TradingView idea. It was a little bit unusual a couple of weeks ago now, where we said something unusual in the dollar, a strange event in the dollar. And this is something, you guys, I don't want to get into it too much now because it's kind of more philosophical. But, we have actually seen some really unusual we have seen signs of people broadly selling American assets overall. And I don't want to overstate it, but this drop in the dollar recently, combined with the drop in the S&P a couple of weeks ago, was completely atypical. It was things like this have actually never happened in history almost, to see the dollar crash and stocks crash. So there are some signs here of people reducing U.S. exposure. Now, we've heard a lot about it. It's gotten a lot of media attention. And I think we have to realize is that what is U.S. assets in terms of what is the U.S. stock market? It's high multiple growth stocks. It's Microsoft. It's all these sort of companies. When you look at companies like Microsoft, you look at companies like ServiceNow, which is to me one of my kind of favorites as a bellwether. This thing had an enormous rally at the beginning of the AI sort of boom. And it's kind of like, it's not your Mag 7 top tier, but it's one of those kind of companies that's always present. If something is happening in tech and IT, they are involved and they're going to be an interesting sort of indicator. And they basically had when they had this gap, they stalled and just died. Very high multiple on a name like this. A lot of these names, things like Adobe, we did a TradingView idea on. Just this continuous series of lower highs on the weekly chart and very negative momentum. So I wanted to just kind of point this out because for me, there were a lot of signs here of money leaving U.S. stocks as a product, as an entity, which is large cap growth. And so to me, well, it's large cap, it's growth, it's high multiple. And therefore, it makes sense that people are looking to things that are not large cap and not high multiple and not growth. And they are in many ways, energy stocks are not secular growth stocks. They are cyclical growth stocks, and they benefit from a different kind of environment, a kind of environment we haven't seen in a long time, but a kind of environment that might actually be coming back. So I think right now we have to be thinking that way. It's also a new year, and if energy is outperforming and large cap growth and the NASDAQ is underperforming, we can't ignore that.
I have to say the dollar chart is something that I think that's also fascinating quite a few people, which this element that the dollar got so weak so quickly. And yeah, exactly. What a great post. Strange event in the dollar. Could you walk us through what you were seeing at the time of that post? And I just want to say this is also why it's important to follow people around the web who are spotting great insights. Because if you think about it, you follow great people. You have David Russell here who's running the TradeStation account, creating these ideas. You get this notification and alert when it happens. I mean, if you had read this idea and taken it seriously, this was a few months ago, right? Or a month and a half ago. Very, very helpful.
Yeah. It was a week and a half ago. But the key thing is, so you had the week that ended, I think, on March 7th. And so I went and I used AI to create a custom script on this. It was a very unusual script, but it was something where I just realized this was a weird event. I knew it was unusual, but how do I prove it? So I used ChatGPT to write a special script. And all it did is it would, and this was a little bit tricky because the dollar index and the S&P, they have different dates associated with them. One of them opens on Monday, one of them opens on Sunday. But anyway, it took a lot of work. But what I did was this arrow down here at the bottom, this is the custom indicator. And I set it to an interval of -3. So what it does is, and it has a comparison symbol of S&P, and then in the main chart is DXY. So what it does is, if both symbols fall 3% or more, it will plot the arrow. And the thing is a lot of people will know is that the dollar tends to move in the opposite direction as stocks. So if the market's selling off, usually dollar moves higher and vice versa. So to see the dollar moving lower and see stocks moving lower at the same time was completely atypical. This one that happened in the early 80s, I think, could almost be discounted because it happened in the context. This is back when Paul Volcker was raising interest rates and you had this violent rally in the dollar. It was shooting higher and it had 1 week that was just a sharp pullback. And it was in the context of an uptrend. But this is not in the context of a weekly uptrend. So this is something I want to just kind of point. I mean, to me, this is very meaningful and interesting. And we noticed this, and it did kind of suggest people are selling U.S. stocks, which means they're selling large cap growth. They're selling the dollar. These things kind of seem to go hand in hand. So there has been a bias to a certain extent away from U.S. assets. I do think we have to realize, though, that has happened now for a while, and we have to see how much it's going to continue. We did some TradingView ideas on things like EFA, which is the global ETF. I'm not sure exactly at this moment what to think about this, but I did think it was interesting because there does seem to be something happening of this total dominance, American exceptionalism, the total outperformance of U.S. stocks that seems to be, I mean, there's evidence that it's ending at this time. It doesn't mean that it's going to continue. It doesn't mean it's going to get more extreme, but there does seem to be a shift from the high multiple U.S. stocks to everything else. And in many ways, energy is one of those other things.
I've seen that commentary quite a bit lately, especially, just around the web or even on some of the sort of TV shows for markets, which is that the like European stocks, for example, have really caught a bid effectively almost out of nowhere. And like you just said, now if you compare, oh yes, here you go, great idea. We should run through this. Also, I'd love to know what indicator you have down there on that graphic. But this has been a really high level point of discussion, which I think also does just add great context to corrections, bear markets. There's always kind of something that is still showing strength. Don't get me wrong, there's definitely been moments and crashes when that's not the case, but it's so interesting to see that equities went through this correction, crypto went through this correction, all these other assets went through this correction. Then you look and European stocks are showing some strength. So talk to us about this idea that you published.
Well, so this was earlier this week, and basically, I mean, this is when the S&P was crashing. And look at European stock. This is global stocks. This is about 40% Europe, like 40% Japan, and then a bunch of everything else. So basically, to see this kind of strength at a time when the S&P was crashing says something. This shows a 21-day, which is basically a trailing month relative performance. There's only 2 times in history that it was a higher reading than this. And one was during COVID, when it was just like crazy volatility, when one day it was up a ton and down. So it's irrelevant. Same thing with 2009. You get these outlier events when the moves are not consistent. It's just the chart is just up, down massively, and it doesn't mean anything. This is different. This is a smooth, steady outperformance in global. And we had basically, this was an inside week, and that's what kind of got my attention. And you can see here, I outlined the fact that it was a week on the daily chart by using this shaded box. But essentially here, what I think is interesting is that it totally outperformed the S&P. And the other thing is, if we look at a longer term chart of EFA, on like, I'm going to go to a monthly chart actually, you can see that this has really gone nowhere. It's pushing back the levels from like 2007. So the fact is, if this thing actually escapes, it could actually enter a new true bull run. And I think that actually could be very significant. And so this is, to me, something that I think is, could be setting up, and this could be something we see play out over the course of 2025.
That is a fantastic chart. So that idea you published, it shows the symbol E, I think it was EAFE.
EFA.
Basically going up for the last month when, as an example, S&P 500 has been going straight down. Like, is that sort of the divergence? I mean, that is such something else. And so now it's nearing its highs from the pre-financial crisis levels. Is that what we're seeing here as well?
Yeah.
Wow, absolutely remarkable. And how do you think, what's so interesting is, so do you think the weak dollar is sort of supporting that at all? Because maybe some of these European countries now theoretically have stronger euros compared to the dollar. Maybe they can buy more goods. Or do you think that dollar chart is playing a reflection at all into this?
Yeah, I do. And I think that if we actually see the dollar weakening, I mean, the dollar weakened, U.S. stocks went down, this thing went up. I mean, it's not that obscure to actually see that. It's not that hard to see the link, because this is basically non-US stocks. So from my view here, we have something that is a big maybe, and we have to be careful of like getting too aggressive too quickly in it. But if it does break out and run, that's what I mean. It's like also kind of like Mark Douglas would say, you have to accept what the market's giving you, not what you want it to give you. And if the market's giving you a rally in European stocks, and you want to be buying Apple and Palantir and Microsoft, well, you have to basically embrace what the market's giving you. In my view here, this is something where it's not fully confirmed. I'm not trying to recommend anything or anything like that. It's more just a question of recognizing here is that we're getting like a potentially interesting signal here, a potentially interesting thing that could be significant, because it hasn't run in a long time. And when things break out like this, they can potentially extend for like a couple of quarters and really move. And I think that's maybe what we need to realize is the potential here is that this is not just, it's kind of up a little bit in the last like year or two. We're talking about a generational, historic sort of thing where global stocks have underperformed really for 15 years. And so this is something where if they do have a breakout and run, there would be potential for this to maybe last longer than you might immediately think.
And do you think, just in terms of risk management, because I'm looking at this chart also just sort of thinking to myself along the lines of like, this is very interesting. Like I need to go look for, maybe it's time to go check out a few European opportunities or global opportunities. Do you think though that just in terms of like TA on the chart, do you find that when those levels get hit, say from 2007, those all-time highs from 15 years ago, maybe more, does it take a little time sort of to break through them? Or like, is that something to watch and mark and maybe set an alert on?
Yeah, and the fact is, I mean, I'm not really sure what to make of this yet. I don't have a clear plan on it. What I do know is that this is something that's out there to watch, and I need to think about it because I haven't thought about global stocks in a long time. I need to start reading a little bit more from what's happening with the ECB, with this new German government, because it has a lot to do with German politics and German plans. But I think it's just important to realize. And then the other one I think is interesting, I want to just quickly mention, is China, FXI, because China has been actually outperforming. The FXI has been outperforming. And it's interesting to see it kind of pull back here. And what's interesting is they actually have an event when they're going to be with Chairman or President Xi. There's going to be some kind of business event that's happening with him. So I want to kind of point this out over the weekend. China has been absolutely outperforming. Look at the S&P and then look at this. I mean, this has been just trending higher all year. This is the FXI, stocks like Alibaba, for example. XPEV, we did a TradingView idea on, and it's been Tesla was crashing and this thing's just shooting out. Now it's basically had its earnings and they're taking profits in it. But this is something also where people might want to be thinking, does it get back around 20? Not now, but maybe in 2 to 3 weeks. So I think right now we have to realize that this is a bigger sort of trend. It seems to be happening, more broadly. And so I think this is something that I'm watching, but I'm not sure exactly what to do with it now. We know there's some geopolitical events. We know we have things like inflation and stuff like that coming. And at this point, it's one of these things when it's like a half-formed idea in terms of what to do next. And I think like we did a TradingView idea on XPEV when it was down here, and it more or less doubled. I think we did it because the pattern was in giving us a clear signal. At this point, I'm kind of waiting to see, but I'm keeping it on my list because when you look at the trends and some of the things that are happening, this could be something where something bigger seems to be happening.
So I have to say on that note, the Chinese stocks have also fascinated me because Alibaba is like, I mean, that chart has been, it almost seems like, I mean, I'm sure they're down today. Today seems to be a broad down day, but some of those Chinese stocks have been moving almost in the complete opposite direction of even some of the large cap US names. And that is just so, I mean, it's just something I don't think a lot of people were totally positioned for. And do you find in these very quick moving environments that sometimes these when people aren't properly positioned and the move happens faster, like is there some sort of slingshot effect to be aware of during these sort of when volatility spikes?
I don't know if it's that as much as the fact that it was the beginning of a new year, and that's always has the potential for what I call investor rotation, when basically people stick with themes and it often matches defined periods of time, like a year. Like, oh, AI was good in 23 and 24, and it's not good in 25. Oh, global's good in 25. Maybe it will be good for all of 20. Maybe that's often how these sort of investor herd mentality things happen, which is one of the reasons why I'm looking at it, and one of the reasons why I think it's important to realize is this global thing could assert itself over much of this year. And so I think for me the key thing is the fact that it was the new year, and also there was fundamental news. There has been fundamental news out of China and out of Europe. And at the same time, the Fed yesterday, they cut their GDP estimates. The estimates of economic growth in the United States have been coming down. So you can actually make an argument that in many ways, the United States now has a higher multiple, and it also has a less promising macro environment. Meanwhile, foreign stocks have lower multiples and potentially more promising environments. Now, a lot of this is played out, so we have to be careful to think it's going to continue in the next week or two. But these are some of the things where maybe in a month or two, they provide opportunities again, and we'll be circling back to them. Notice we haven't done these for a while. We've been doing energy stocks, which is why I wanted to actually quickly just get back to crude oil here, because I just think it's important to realize I have been watching like a little kid at Christmas, waiting for Santa Claus, for this thing to break support, and it has not been happening. So basically, I think we got to realize here is that energy is holding support. USO, or the US oil, which is basically a crude oil indicator you guys have on TradingView. But I mean, it's been holding the support level. And I think we got to just realize here is that when you see energy moving, when you see the energy stocks moving higher, and you see this thing refusing to break, this could be something here where, crude oil has not yet followed the equities. And this might be something here that actually presents itself.
That is, so I was actually recently looking at that chart as well for the exact support line that you have. And I did not have that trend line, but that support line that you have down, I also was observing. It seems like every time it's hit that line, even going back to that point in 2023, and then some moments in early 2024, yeah, it just has not broken down below it. And the great thing about this show, I must say, we were once charting gold, let's say, I don't know, a year ago or 6 months ago, and we were saying something along the lines of like, this triple top keeps getting tested, but it's not breaking apart. It's almost like it keeps knocking on the door. And I think we all know what happened since then. So that line of support has me wondering the same thing. It just doesn't want to break that line. So what does that mean? So super interesting chart you have there. And I had that up as well.
And what's interesting to me is the fact that if you actually look at the most recent rally, it actually made a higher high for the first time on a weekly basis. It truly made, see how it went above this high from October. It actually went above that October high. So it actually tells you in many ways that could be the first sign of this downtrend breaking. Maybe the next sign is the support holding, which means the next move might be this, a move through that, and then a move to new highs in the toward the high 70s. So I think that, you know, you got to look at what it is, and it's like it was a series of lower highs, which is a downtrend, and then we got a higher high, and well, we're not getting a follow through to the downside. So we have a higher high, no lower low, and well, that might just mean that this downward movement is nearing its end. So that's something I'm watching here. And I think when you look at the geopolitical situation, everything else, more sanctions on Iran and everything like that, you know, and the fact that, you know, jobless claims are not going to 300,000. They are still low. We still have an environment where people are like, you know, using energy and stuff like that. So I think this is an environment here where it is potentially, the negative things that we potentially saw happening in energy don't seem to be happening, and something else seems to be happening.
Well, you know, this energy conversation is so interesting. It ties into your commentary too about the rotation, the big themes that can sort of take a hold of markets. And in terms of rotations and these themes or people being caught off sides, maybe too heavily weighted one way and not another, I had to check as an example. S&P 500 index, right? I think it's the largest index out there. It's I'm pretty sure it's known globally, traded globally. Energy only makes up 4% of the index.
Yeah.
And meanwhile, IT tech makes up 32% of the index. And apparently that's one of the largest over the last 3 years. That's kind of been one of the larger weightings in history. So holy cow, you imagine even if energy were at one point to become like 8 or 9% of the index, that's you go from 4 to 8, that's a, you know, it's 100% change. It's a double. So very interesting stuff here, that even though there are plenty of sort of corrections happening out there, as we're walking through, there are some very interesting rotations happening right before our eyes. And I can see now you have this chart of Microsoft open. Walk us through what you're seeing here.
Well, Microsoft's very much the opposite. I want to just kind of point out that this has presented a series of bearish flags on the way down, you know, and it might be now in another one. And so I want to just kind of point out that we see here that this has basically gone down and it bounced up to its 8-day exponential and failed. It's done it again and again and again. And now here it is at the 8-day exponential, basically trying to hold, but just inching under it. And it might set up at this point, you know, this is actually important because this was the old 52-week low over here. And, you know, if we break that, people might actually be looking something closer down to 365 from back here at the end of 23. So, you know, to me, extend that, can extend that line over. This is something where people might look. Now, one of the nice things about this is that this is one of the most liquid stocks in the options market, one of those liquid underliers. So we now have our integration in place where people can connect their TradeStation account via TradingView and trade options. And want to just kind of point that out, that this is now maybe a name people will be looking for something like that, because something like Microsoft, with puts in a name like Microsoft, if people were thinking to the downside, there are ways that they can potentially kind of you know, leverage moves like that with limited capital at risk and actually, you know, take advantage of potential downside. So I want to just mention that, you know, since we do recently have this integration in place, and Microsoft is such an active underlier.
So I really want to discuss options actually, because just as like as a sort of risk management technique in down markets. I think it's fascinating, especially if you have a position you like. And obviously, you know, the call premiums won't be as juicy, but maybe it's a way like to earn a little bit of, premium or income to reduce your cost basis in the down market. But beyond that, someone does ask why, while you were showing Microsoft, while we were talking about the energy weightings and tech weightings, if you exactly would want what your thoughts were on Apple and Tesla. So I see you have Apple here at the moment. Yeah. Let's hear what you're seeing on this chart. And if you want the grand 51% drop in Tesla from its highs, would be fascinating to go through that as well.
Well, I would say that the Apple is interesting because this is a pretty sharp drop, and if you look, it's well below its 21-day exponential, and this is a major company, so this would require something pretty significant in the overall market potentially to just extend lower from here. It does look like a bearish flag, but at the same time, it has dropped a lot, and so from my view here, people might actually want to be thinking about something like Apple it could make more sense to be selling premium in a name like this. And one of the views I always have is that when something it makes sense to own options when you're tightly packed like this and you can extend. But once you've extended, then it makes sense to be selling premium. So like, for example, a person, either they were bearish in this, they might sell upside call spread, or they could own the stock and sell at the money calls. And you could do something like going to the short-term expiration of next Friday, for example, and that would allow you to essentially capture time decay. And we actually have, I can't remember if we shared it last time, Steph, but I have this sort of blog post I did on TradeStation when I kind of help. It's a little memory trick where it's like, T, time decay, is theta. So if you look at those options that have a higher theta, it can actually allow you to say, all right, expiration in 8 days, those are the ones that are going to really lose premium quickly. So in a name like this, people might want to be thinking about selling shorter term options, and that can be done by, if you say you're bullish on it, then you can sell a put spread underneath it, or if you're bearish on it, you can sell a call spread above it, sell calls above it against stock. That's the sort of thing when a name is really extended that can potentially make sense. When something is packed tight together, when it's near that 21 exponential or it hasn't moved in a while, it can extend. And that's when you want to own options, or you want to think about owning options. And when it has extended, you want to think about potentially selling options.
So I have to say, on that note, as we sort of hit the last, 5 to 10 minutes here of the show, exactly the new integration with TradeStation and also with TradingView, so that you can trade options on TradingView for the first time ever, is absolutely fantastic. I love it. And to your exact point, some of those strategies.
I'm not sure if I lost you, Steph, or if you're there, but you have frozen. Well, anyway, I'm going to show this.
Yeah, let's see this.
So
Yeah,
I'm not sure who froze. I'm not sure if I froze or you froze, but regardless, you can go to the symbol up here. You can go to options, and it'll bring up an actual options chain, and then hit thank you, and then we can go over here. You know what? I don't have my integration set up. I actually did not link up my account right now, but essentially, a person will go down here to the trading panel, and they can then connect to TradeStation, and with the limited time we have, I would actually almost suggest you'll go back and watch when we did last month, because we actually go into that. But you can see TradeStation is here. You can connect your account, and then if you have an options account at TradeStation, you can then trade the options by clicking on this and clicking on options. It will bring up an options chain, and that's the main thing I wanted to kind of show people. One of the other things I'll mention about TradeStation is it allows you to do just a real simple thing I do all the time. I scan for the top underliers. I go to TradeStation, I say, show me the stocks that trade more than 10,000 options a day, for example, and it generates a list for me. Because the thing is with options, it makes sense to be trading the things that trade a lot of options. You don't want to be trading obscure things very often because the bid-ask spreads can be difficult. Focusing on the super liquid things can make more sense. You have better pricing on them. So that's another great way you can combine TradeStation with TradingView. Just the two technologies and platforms can be really synergistic.
And
Steph,
by the
are
way,
you
that's
still there? Right, go ahead.
Yep, we're still there. And by the way, that's a great reminder for everyone watching, which is that if you go watch our previous video, we go through the entire integration, full walkthrough, how to use the product, look at the options chains, just about everything that you'd want to know about connecting your TradeStation account and then getting options data on TradingView and utilizing the two platforms, the TradeStation brokerage capabilities with the TradingView platform to find, research, and even execute options trades. So definitely go back and check that out. And David, just a quick thing I wanted to, I was mentioning, but I think we had a slight hiccup on our connection, was the different ways you can utilize options in these sort of, maybe the trend seems more bearish, the volatility seems a little higher. Like, I loved your insight you said about if you think a position is going to go down and you own the underlying, then selling the call at the money is sort of like the juiciest premium. So you're capturing the premium. What other sort of options ideas come to mind for people who want to express a bearish trade in a choppy market like this?
Well, I mean, if your question here, I think if you do want to be directional. And if you think that the market here is at risk, and we're stalling under 5,700, we had the levels that we discussed earlier in the webinar. Tomorrow is Friday. We haven't had any real signs of the overall market bottoming. And so if you are leaning more to the downside, in my view, the thing that would make sense would be to be thinking about breaks of support and looking for things that have basically consolidated but appear to be in downturns. So for me, Broadcom here is setting up a potential bearish flag. And I think at this point, the thing that would be to be potentially think about is to be looking to be owning puts. For example, if this were to move lower, would be to be owning options that have potentially infinite returns if the thing really does sell off. Selling the upside. In this case, we don't yet have the spreads turned on, and I know it's hopefully coming soon. So selling call spreads and something like this right now on the on TradingView is difficult. But over time, that would be a strategy people would look to do. You can do that if you have an account and you do want to jump over to TradeStation to actually do it. You can do it on TradeStation. You can sell a vertical spread above, which you mean, for example, a person might sell like the 200 calls and buy the 205s. Then you collect the premium from the 205s, the 200s, and then the 205s are a hedge in case it jumps above 200. Your loss is limited. And if you see a thing that you think doesn't have a lot of upside, for example, we saw people rolling calls down recently in super micro and also AI, this stock. People have been continuously selling upside in this name, C3 AI. And I keep seeing large amounts of people selling calls and rolling them down to lower strikes to collect premium. So that's something also I think is, we are definitely seeing there are large institutional players who are actually using this strategy. And just the one thing, though, is that right now we don't yet have the spread functionality, but I think it's coming soon.
So I just love the layer of insights and possibilities that options add on. It's no longer a, hey, you buy here, take profit, stop loss, or sell here, take profit, stop. It's you can create these like dynamic hedging strategies. You can gain insights from them, like your commentary just now about seeing the rolling and the call options. Absolutely fantastic. That's such a rich layer of data to add on to everything that people can already do with TradeStation and TradingView. Well, David, I know we've got about 5 minutes to the close. The action is like just moving again. Here we are. We've got QQQ, NASDAQ 100 up. I'm actually wondering if that's bear flagging. Why don't we end with a few final notes on what you're seeing and maybe some other sort of tips for choppy, volatile markets for all of the new viewers out there?
My view here, I'm continuing to look at the September lows. And I think that at this point, this is something where it has tried to bounce, but there's a lot of things here that still remain kind of negative. We have the whole thing of April 2nd, the tariffs, knowing more then. That's a long way off still. And, I think we're seeing something like QQQs here is that from my view here, we seem to have a pretty strong flag in place. And I think we got to remember that tomorrow is Friday. And if we do start to see a break through this flag, this could accelerate. And we have potentially a spot that is hypothetically some decent space on the chart. And so that's kind of what I'm focused on here. I think that if people look at that, there's a potential to capture that move decently. And people should be kind of, at this point, that's maybe the thing that has the most potential to be kind of thinking about. Aside from that, we have written about things like gold miners and stuff having broken out, and they have done that. But in a bearish market, if the market were to continue lower, these things could chop around GDX. But this is also very similar. I would just add and end almost on this. This is similar to EFA. This thing is breaking levels that go back literally like a long time. This thing has not been where it was. It's hitting levels now from back in like 2013. So again, gold is is above 3,000, and GDX is nowhere close to where it was when gold was like at 1,000. So I think this is also something here where this is breaking out when the rest of the market is weak. And I think at the end of the day, and we said this, Steph, in one of our very first webinars talking about Tesla, is that Tesla basically, the technicals tell you what's happening fundamentally. And, you did ask about Tesla. So, I mean, I would just add with something like Tesla here, I have to say, I have no idea what to think about something like this, because now there's talk that people are saying Elon Musk should step aside and all sorts of things like that. This is, to me, something where technically it's really not as much of a technical story. This is something where there's a lot of other catalysts that could happen. You have no idea what sort of personality or political catalyst could suddenly trigger moves in this stock. So for me right now, Tesla is pretty hard to trade because, you know, you could say, oh, it's a bearish setup and whatever, and then Elon Musk could do something and then it could just squeeze real hard. So I think things like this are not good for trading, really, because honestly, trading, we want to have clear patterns where we have probabilities on our side, when we can look and say we have a setup that works. And for me right now, Tesla doesn't really fit that.
That was such a refreshing take on Tesla, because I've spoken to so many people about Tesla. It's so alluring coming off the highs like that. And there's been so many charts and insights about, okay, here's the bottom. All right, here's this. Okay. And your breakdown there was actually pretty refreshing of like, this thing is really not easy to read. The chart is a little bit funky. There's all these levels coming up. You've got, I mean, if Elon Musk steps down, that's, I mean, I don't know what the stock would do, if they'd like it or not, because he's been so busy. But yeah, that is a refreshing insight. And that's also a good reminder too in this show, while we record during sort of the recent price action, which is basically that, you know, pay attention to the setups, all the details, analysis, drawings, insights that David has walked us through today. And then in accordance with the new options integration, I think it's kind of wise to utilize some of that when you're looking for trades in a market like this. So with that being said, David, it was wonderful to have you back. I know that you want to get to your desk before the market close. We've got another epic close coming up, and curious if you have any final words for us.
Yeah, I'm actually good. I've done what I need to do. But last thing I would just say is that let's not forget, we're nearing the end of the first quarter. 2025 is a thing now. We're actually in a year that now has an identity. And let's think about that. And it might not be the identity we wanted. It might not be the story that people hope for or want or anything like that, but it does exist. We can see now this year has a personality, and there are things happening, whether it's global, whether it's gold, whatever it is. And I think that we let's kind of use the charts to know what those things are and to try and follow what the trends are, instead of you know, following our hearts or following what we want or following what was true. You know, things keep changing, and I think that's an important thing just to remind now that we are in a year that has an established personality.
And let me, on that note, also just give a shout out to Peter, because Peter in the chat has been asking for Tesla, and so you think he's thrilled that we got to it. And for future shows, you'll find this interesting, David. There was a request or two for the Nifty 50 in India, so maybe in a future, maybe in a future show we'll go. I mean, maybe internationally, like that might be interesting. I don't even know if there's an India ETF. Maybe it's out there, but maybe that's one for us to write down. So on our future show, if you were the one asking about the Nifty 50, please know that we just may cover that then. So everyone, wonderful to have David Russell here once again, and TradeStation. And please do keep in mind that every insight you get from this show, you must also follow the TradeStation account on TradingView, because you're going to get these ideas published to your feed just, you know, by the day, by the week. And for our next show, you'll be even more prepared to see what David's watching. And by the way, I'll just add, I don't think there's many other ways you can get this dual access, both in video format and written format, from someone like David. But if you're here on TradingView, you know, you're in luck. So thanks a lot, David, for joining us again. We will see you next month.
Thanks, Steph. Have a good month.
You too. Okay. Goodbye, everyone. And thank you to all of the people who jumped in. And it was awesome to see the chat as active as it was. So you're welcome, Dan. You're welcome, Peter. You're welcome, Sam. And all right, we'll see everyone next month. We're going to wrap up now.
Take care.